Okay, everyone, we're going to go ahead and get started. Today is Holsinger's webinar on the One Big Beautiful Bill. So welcome, everyone. We do have a Q&A tab. So if you have any technical difficulties, sound, so forth, please let us know in there. We'll try to get it taken care of as quickly as possible. I'm Lisa Coach. I'm a manager in the tax department here at Holsinger, and today we are going to have three people presenting: myself, Amanda Kelly, who's also a tax manager, and Will Stunkel, who is a director. We're dividing the webinar into three parts. The first part will be mine, and we'll deal with individual provisions, and then Will weigh in with payroll, and then Amanda will finish up with business. Okay, so with that, let's get right into it. So the One Big Beautiful Bill Act, which is OB3, was the biggest set of tax law changes since TCJA, which was the Tax Cut and Job Act. And President Trump signed this law on July 4th of 2025. What we intend to do here today is to give you an overview of some of the key measures. Obviously, we are not covering everything, and we will try to give you some tax planning strategies as well. So I'm going to go back a little bit to TCJA, which was the Tax Cut and Jobs Act of 2017. So in 2017, when President Trump was in his first term, he signed this into law. And this was for tax years 2018 through 2025. So the provisions that were set up in TCJA were set to expire, but in comes the One Big Beautiful Bill, and it makes them permanent. So those are the things I'm going to talk about now. The first permanent one was individual income tax rates. So lower rates are locked in and they're indexed for inflation. And there are your rates out there, 10, 12, so forth. Just for point of reference, prior to TCJA, so back in 2017, the highest tax rate was 39.6%, and now you can see it's 37%. And some of the other brackets, it was around like a 2% lower. So that's good news. We've locked in these lower rates. The standard deduction is permanently increased and it is indexed for inflation, and your standard deductions are out there. So you're either taking the standard deduction or you're itemizing. And again, it's great news that this is indexed for inflation because prior to TCJA, they were not. Some other permanent changes: OB3 made the following permanently eliminated personal exemptions. We haven't had a personal exemption since 2017. Permanently terminated miscellaneous itemized deductions, which were previously subject to 2% of adjusted gross income. Just a note on my part, I think we're creatures of habit. So a lot of these things people still think are deductible. So I get a lot of questions about safety deposit boxes, tax preparation fees, fees for investments. Those things were permanently terminated with OB3. So no need to send us those invoices. The mortgage interest deduction, there's a $750,000 indebtedness limit, and that was made permanent. A lot of people don't know that if your mortgage is over $750,000 or $375,000 for married filing joint, the amount of mortgage interest that you can take as an itemized deduction is going to be limited. And then OB3 permanently increases the AMT exemptions. However, the phase-out thresholds revert to the 2018 levels and are inflation adjusted. Just as an FYI, AMT, alternative minimum tax, is a separate tax calculation for higher income individuals. It's just designed to ensure that these taxpayers pay a minimum amount of federal tax.
Lisa, not to interrupt you, it sounds like maybe we're having some issues with people trying to see the slides. If anybody can comment on that so that we can work on that technical issue, please let us know. The team says still waiting, but they can hear Lisa. I'm sorry.
Cherry.
Lisa, people are saying that the team says waiting still, but they can hear Lisa talking.
Okay, I'll work on that. Lisa, I think you can.
Okay, sorry, everyone. We're going to work on the slides, but you can at least hear what I'm saying. Okay, continuing on. Well, back on the AMT issue. So you could be, so a taxpayer could possibly have a low tax or no tax at all, but then they're also going to be subject to the second calculation, which is alternative minimum tax. And that's going to limit some of the exclusions and deductions that they had. So even though they may not have tax at one point, federal tax, they're going to be subject to this other alternative minimum tax. Okay, continuing on with the permanent individual tax law changes with OB3. OB3 permanently terminates the moving expense deduction except for military-related moves. And OB3 permanently limits casualty loss deductions to only those attributable to a federally declared disaster. Now we're going to move into some of the new things from OB3. So one of the big ones is an enhanced deduction for seniors. So for tax years 2025 through 2028, there's going to be an additional $6,000 bonus deduction for seniors age 65 and older. If you're married filing joint, both spouses qualify, that's going to be $12,000. So this is added to the existing additional senior standard deduction of $2,000 for single and $1,600 for joint. And like with many things, there's going to be a phase out. So the phase out begins at $75,000 or $150,000 for married filing joint. What this means is this deduction is going to be reduced by 6% of your modified adjusted gross income when your modified adjusted gross income exceeds $75,000 or $150,000 for joint. And then you can see I put there that this deduction will be completely phased out for those with modified adjusted gross income of $150,000 or $250,000 for married filing joint. And for most people, modified adjusted gross income is going to be your adjusted gross income. Married taxpayers must file jointly to claim the deduction, and there's going to be no deduction for married filing separately.
Yep.
One thing I wanted to note here is whenever this bill was being introduced, the House had a bill, the Senate had a bill. So social media and media in general they were coming out with different points from each that like the House bill or the Senate bill, and they were publishing that. So I guess I just want to caution you that not all of those made the final cut. A lot of them didn't make the final cut. So try not to rely too much on what you've heard in social media and look was what made the final cut into the final OB3. That was my final point here. Contrary to the email sent by the Social Security Administration and social media, the taxation of Social Security benefits has not changed, and the senior deduction is not tied to the receipt of Social Security benefits. Because I think some media went out saying Social Security benefits are not going to be taxable, and that was not correct. So let's take a quick example. If a single taxpayer age 65 or older in 2025 had 75,000 and the amount there above is 5,000. So take that times the 6% and $300 is going to be disallowed. So instead of getting a $6,000 bonus deduction, they're going to get a $5,700 deduction. But if you add that in with their 2025 standard deduction of $15,750, and then they get their regular additional deduction for being 65 or older of $2,000, they're going to get a total deduction of $23,450, which is pretty good. Okay, let's move into another individual provision, and this is charitable contributions. So I like this one because they brought back the charitable contribution deduction for non-itemizers as well. So you can get a deduction, and I'll go through the details for charitable contributions for both itemizing and non-itemizing. So for itemizers, previously, if you made a $500 contribution, your itemized deduction was $500, but now there's a base set into it. So itemized charitable contributions are deductible only to the extent that they exceed 0.5% of AGI. So let's just take a quick example. If a taxpayer had AGI of $100,000 and they made $5,000 in contributions, they're only going to be able to deduct $4,500. So you can see that 100,000 times 0.005 equals 500. So they're only allowed to take 4,500 of their charitable contributions. Contrasting that with charitable contributions for non-itemizers, they don't have this base. Taxpayers are allowed $1,000 or $2,000 for married filing jointly for certain contributions. So these must be cash contributions. That same does not hold true for itemizers. So itemizers can take non-cash contributions as well as cash contributions. Non-itemizers have to use cash contributions. They must be made to a public charity. They must meet certain other requirements set forth in Code 170P. Then they must have written acknowledgement from the receiving organization for contributions over $250. And two more things on contributions. The enhanced limit allowing cash contributions to public charities up to 60% of AGI is now permanently extended, meaning if you make $100,000, you can contribute 60% of that to charity, 60,000. But if you go above that, that amount will be carried forward to future years. And lastly, there is going to be a cap on the tax benefit for high income itemizers. And without going into the detail of how to calculate that, taxpayers in the 37% marginal bracket will now receive only 35% tax benefit per dollar of itemized deduction. Okay. Next biggie, SALT. So state and local tax cap was previously $10,000 for itemizers. That is increasing in 2025 to 40,000. And then it's going to continue to go up until 2030 when it's going to revert back to 10,000. And here we go with our phase outs again. So your deduction is reduced by 30% for amounts exceeding modified adjusted gross income of 500,000 in 2025, and that will continue to go up. The $40,000 is for all your state and local income tax that you pay, local earned income tax, your property taxes. And that's a pretty big number, which the 40,000 exceeds any standard deduction. So if you do have $40,000 in state and local income tax, you want to try to take advantage of that. And there are a lot of planning opportunities around this. Especially if I'm talking specifically if your income's exceeding $500,000. So everyone's circumstances will be, individual to yourself. So we at Holsinger would love to talk to you about some tax planning ideas. So please reach out to us and schedule a consultation, and we would really like to help. Two other itemized deduction OB3 issues, miscellaneous itemized deductions for unreimbursed employee expenses for eligible educators. The amounts exceeding $300 are itemized and not subject to the 2% floor. And an eligible educator is an individual who's a kindergarten through grade 12 teacher, instructor, principal, or aide in a school for at least 900 hours during a school year. So OB3 actually expanded this. They added interscholastic sports administrators and coaches as eligible educators, and expenses outside of a classroom used for instructional activity are allowed. So this is great news for teachers because most teachers I know spend a lot of out-of-pocket money in their classroom. Mortgage interest deduction, mortgage insurance premiums made qualified interest beginning 2026. And the deduction is reduced by 10% for each $1,000 exceeding AGI of 100,000. And the last OB3 issue on or change on itemized deductions is wagering loss deduction. So OB3 Act permanently requires wagering losses to include any otherwise allowable deductions incurred in carrying on any wagering transaction. So starting in 2026, taxpayers can only deduct 90% of their wagering losses. This new limitation is in addition to the general limitation that wagering losses cannot be deducted in excess of wagering gains. So they're saying that your losses can't exceed your winnings. So the limitations will be applied in this order. First, you're going to take your total wagering losses and multiply that by 90%. And then you're going to limit the reduced losses to the total wagering gains. Again, your losses can't exceed your gains or wins. And for professional gamblers, their ordinary and necessary business expenses are treated as wagering losses. So anything like their meals or traveling, that has to be included in that wagering loss number, subject to the 90%. Okay, let's move into credits. The child tax credit was permanently increased to $2,200 per child. That's going to be indexed for inflation, and $1,400 of that is refundable. You have phase out thresholds of $200,000 or $400,000 for married filing joint, and those are made permanent. The other dependent credit of $500 is a non-refundable credit, but that was made permanent, and the dependent must be a U.S. resident, and there is no inflation adjustment like there is for the child tax credit. And adoption credits, there's a credit or exclusion from income of up to $17,280 in qualified expenses per eligible child. So this applies to each adoption effort, not the tax year. And OB3 makes $5,000 of this amount refundable, and the non-refundable portion can still be carried forward for 5 years. Energy credits. I think the big news here is if you're doing these, get them done quickly. The previously owned clean vehicle credit and the clean vehicle credit that's set to expire September 30th of 2025. So if you're looking to buy a new electrical vehicle, you need to get on that. But what the detail on this is if a vehicle is acquired as of the date a written binding contract is entered into and a payment has been made. And the payment can be a nominal down payment or a vehicle trade-in. So you don't actually have to physically have the car by September 30th, but you do have to have a written binding contract and some type of payment has been made. The energy efficient home improvement credit and residential clean energy credit are going to expire after December 31st, 2025. And in this, placed in service means it's purchased, installed, and being used. And then the alternative fuel refueling property credit and new energy efficient home credit are going to expire after June 30th, 2026. Qualified business incomes. So 2 QBI deduction changes beginning tax year 2026. The limitation phase-in ranges increased to $75,000 or $150,000 for married filing joint. There is a new minimum $400 deduction with at least $1,000 in qualified business income from trade or business activities in which the taxpayer materially participates. And the Act makes permanent the current 20% pass-through deduction. Um, 529 plans, so some individual provisions on that with OB3. Just as background, 529 plans are tax advantaged investment accounts designed to help individuals save for education expenses. And what OB3 does is it expands upon what these distributions can be used for. So distributions from 529 plans after July 4th of 2025 apply to more expenses attributable to enrollment or attendance of an elementary or secondary public, private, or religious school. And a biggie here, this includes homeschooling. Some examples there of expenses that will now count would be CPA or bar exams, welding, mechanic, or HVAC credentials, and then K through 12 expenses like curriculum materials, tutoring, educational platforms, and standardized test fees. And then the distribution increases to $20,000 per child per year. With the education expenses on the rise, this was a much needed adjustment. Few other things, ABLE accounts. The Able to Work initiative was made permanent, and Achieving a Better Life Experience account is a tax advantage savings and investment account for individuals with disability that allows them to save and invest money without jeopardizing their eligibility for public benefits. This OB3 allows certain ABLE account owners who work and earn income to contribute above the annual ABLE contribution limit. And ABLE account contributions remain eligible for the Savers Credit, and the Savers Credit is a non-refundable credit for low and moderate income individuals who contribute to a retirement account. And the last thing on the ABLE is tax-free rollovers from 529 plans to ABLE accounts are made permanent. And then on health savings accounts, OB3 said that expenses from direct primary care service arrangements can qualify for medical expenses for HSA purposes. Okay, here comes one, car interest deduction. So you do not have to itemize to be able to take the car interest deduction. OB3 is going to allow deductions up to $10,000 of interest on new car loans. Those are those from 2025 through 2028 for the purchase of a new personal use vehicle. Qualified passenger vehicle loan interest is paid on a loan incurred after December 31st, 2024, which I did not make it into, so my interest is not going to be deductible. Loan interest paid exceeding $600 in a tax year must be reported on an information return. We do not know what that information return is going to be yet. We're thinking it's going to be like a 1098 that interest comes on, but stay tuned. That's another thing that we definitely wanted to mention is there's a lot more to come on the OB3. We're not really sure how a lot of these things are going to be implemented. Obviously, there'll be some new forms. Our tax forms are going to look different. You know, we may have a new schedule. We may have some new line items. We're waiting to see. The vehicle must be used for personal purposes, and it must be a passenger vehicle with final assembly occurring in the United States. And there's a list of requirements listed there. I'm not going to go through all of those, but you can see them there. Car loan interest deduction, there is a reduction, of course. So although the allowed deduction is reduced by $200 for every $1,000 of taxpayers' modified adjusted gross income exceeding $100,000 or $200,000 for married filing joint. And married taxpayers do not have to file a joint return to claim the deduction. And estate and gift tax exemption, which is the taxable amount you can transfer during your life and via your estate free from gift and estate taxes. OB3 increases this exemption to 15 million or 30 million for married filing joint, and this exemption is made permanent. Account. So President Trump has an account named after him, and it's a new child savings account introduced by the OB3 Act. These are tax advantage saving vehicles for children under age 18, and they'll be functioning similarly to IRAs when they reach adulthood. The child is the owner of the account. There is going to be a pilot program with an automatic federal seed contribution. So the government is going to contribute $1,000 to the account of each qualifying child. And those are going to be children born between January 1st of 2025 and December 31st of 2028. Families, which mean parents, relatives, friends, they can contribute up to $5,000 annually to the Trump account, and this will be indexed for inflation. Contributions provided to Trump accounts from tax exempt entities such as private foundations are not subject to the $5,000 limit. However, these contributions from unrelated third parties must be provided to all children within a qualified group. Employers can contribute up to $2,500 per year, and these contributions will count towards that $5,000 limit. This contribution is not considered taxable income to the employee, and family contributions are not exempt from tax. Funds must be invested in low-cost U.S. equity index funds until the beneficiary reaches age 18. So this is going to be either an S&P 500 or another index comprised of equity investments in primarily U.S. companies. And no withdrawals are allowed before the beneficiary reaches 18. Able account rollovers are allowed, and normal traditional IRA distribution rules apply for withdrawals after the child reaches 18. These accounts can be established starting January 1st of 2026, and contributions can be made beginning July 4th of 2026. I think you're almost done listening to me on the premium tax credit. So a premium tax credit is a refundable tax credit that helps eligible individuals and families with low or moderate income afford health insurance coverage, and it's purchased through the marketplace. This credit works on a sliding scale so that lower income individuals receive a larger credit. Prior to 2025, if the premium tax credit that the taxpayer was entitled to for the year exceeded the amount of premiums they paid, the taxpayer generally owed the excess as additional income tax. But there was a repayment cap which limited the additional tax to an applicable dollar amount for taxpayers whose household income was less than 400% of the federal poverty line. So the takeaway from OB3 is that OB3 is striking this repayment cap. So as a result, all taxpayers will have to repay their excess advance premium tax credits in their entirety. So that's a pretty big change. And last thing I wanted to mention is obviously, and I've said this before, there's way more guidance to come. So, we will need to keep up on this and keep updated as we go. And again, I just want to let you know that if we at Holsinker are more than happy to help. If you could call us, we'd love to set up a consultation appointment with you. And if anyone has any questions, we can field those now. If not, I'm going to move over to Will.
Good morning, everyone. I hope you are doing well. We are going to be getting into my favorite part of the presentation, talking about payroll-related provisions. These also kind of touch into individual tax provisions as well, because of the fact that the actual deductions we're going to be talking about for the two first things are things that will be on personal income tax returns. So the first one of the big kind of headline pieces or parts of the legislation is the payroll provision for overtime, and the way it was implemented is a deduction, and so each taxpayer will be entitled to a deduction. So for an individual, that's $12,500. For a married filing jointly couple, each spouse is eligible for $12,500 of a deduction. This will exclude certain individuals related to their compensation. Highly compensated individuals means somebody that has over $160,000 in wages and tips. There is an income limitation for this, and this is a temporary deduction currently that would have to be renewed if it were to be or extended essentially. It is an above the line deduction. So it does not but it does not reduce your AGI. So a key thing to be aware of is the fact that there's been a lot of, again, it's kind of social media chatter about whether or not you have to itemize for this deduction. You do not have to itemize your taxes personally for this deduction. It will be something that will be, again, an above the line deduction, but one that does not reduce AGI. Regardless, so you can essentially claim your standard deduction and then also receive this deduction if you have qualifying overtime. A couple aspects about qualifying overtime to be aware of is in relation to the definition of it. It's based in the passage of the law. It's based on the Fair Labor Standards Act. And so a key thing about that is that it references the premium amount that's paid under that act. And so that essentially means that instead of probably kind of the common reference to overtime pay being your entire rate that you're receiving per hour at the overtime rate, it's actually only referring to the 0.5 part of the overtime rate that you're receiving. So that example on the right side of the slide kind of walks through what that means. And so just to kind of walk through that example with you, that means if someone's receiving regular wages of $18 an hour and they work 20 hours of overtime and the overtime pay is $27 an hour, that means that if you meet all the other qualifications, the allowable deduction is going to be essentially that $9 differential between $27 and $18 times the 20 hours of overtime, or $180 deduction in this example. And so just keep in mind is essentially the differential in your overtime rate compared to your regular rate that's going to affect this deduction. A couple of other things that employers are going to need to be aware of on the payroll end of things is, of course, whether or not all overtime wages qualify for this. A couple of things we're waiting to find out from when the IRS actually publishes more guidance is, are they going to stick to the letter of the law that was passed? And it says the required payment of overtime. So a lot of employers are very generous with in terms of their overtime compared to the law. In that they may pay overtime for, say, working over 8 hours in a particular calendar day. However, the law as it's written is based on 40 hours in a calendar week, or 40 hours, I should say, in a pay period week, because that could be different from a calendar week based on how the employer handles things. And so essentially, what overtime will qualify for this deduction, the question is still kind of outstanding, is whether it's going to be just that 40-hour week or not. I expect it will be just that 40-hour week, in terms of hours in excess of that 40-hour threshold. And so if employers are paying a slightly more generous overtime calculation, they will have to then be able to report for their employees what hours are actually the qualified hours of overtime versus just their overall total overtime. And so that last point on the slide that talks about reporting on the W-2, there is still some information for 2025 that will need to come out. The IRS has not given us the guidance for the transition period here in 2025 of what they're going to do. They have come out and said they are not adjusting any 2025 forms for W-2s. And so this one provision here at the end, is kind of more on the go forward basis that in 2026 and beyond, it will have to be listed on the W-2. We're waiting to find out still from the IRS what 2025 is going to look like. However, I would advise any clients that are going to have this reporting requirement that if they don't have an easy way of ensuring that the amount of overtime that's being paid to employees is going to be easily accessible to then report, like in their records. If it's kind of convoluted or something like that, being able to come up with a way to have it be a definitive calculation they can then include in the reporting at the end of the year in some fashion. Doing that now, getting a leg up, so that way you're basically ready to go in January when you're issuing W-2s and that sort of thing, will be important. On our next slide here, we just have a few more informational points about the overtime deduction and qualifying for it. So there is, as I mentioned on the other slide, an income limitation, and this is when, as a single individual or head of household individual, your adjusted gross income is over $150,000. That will be the threshold for when this starts to phase out. If you're married, filing jointly individual, it's over $300,000 that this will start to phase out. A key point noted on the last bullet here is that the married taxpayers that are filing separately, basically, that if you file separately, that could be a problem with this provision, unless you meet the unmarried consideration kind of like exception under section 7703B related to essentially living separately for at least 6 months of the year from your spouse, if you're married but separated. Another key thing, and this is true for a lot of the provisions in the changes made in the OB3 bill, are that you must have a valid social security number. A key thing to just highlight as well is that it has to be before the return due date that you have that social security number. If you don't have a social security number, if you use an I-10 and you're waiting for a social security number, you're going to want to file an extension and wait until you have that social security number in hand before you file. Because of the fact that the provision specifically allows the IRS to treat the lack of a social security number as a math error, they can basically just correct. I would expect that to be something that happens pretty much automatically, and so that could generate a surprise if you don't wait for having that social security number. If you're currently waiting on it, I would definitely recommend waiting on it. Or if you're changing your current status in terms of work status or social security status, being able to go from an I-10 to a social security number, doing that as soon as you possibly can to ensure there's no delays, both in terms of getting that social security number, but then also in terms of how it would affect your tax filings at the end of the year. Our next provision that we're going to talk about is the TIPS deduction, also another kind of headline part of the legislation. Again, this is going to be a deduction that is going to be on a person's personal income tax return, but we're also going to talk through the payroll implications of this. This is, again, retroactive to the beginning of 2025. The Treasury is going to define what the allowed occupations are going to be for this. So unfortunately for accountants, I'm guessing we're going to be excluded from this because we don't traditionally receive compensation and tips. But I would imagine things such as restaurant workers and servers and those types of professions that generally are tipped and receive a tip on a regular basis are going to be included. So kind of as the Treasury kind of gets through their analysis, they're going to release a list, and there's also going to be codes associated with that list of employment occupations that will then be part of, as you see on this slide, there's a draft of what's been released now just the other week for the 2026 W-2s of what we're expecting from the IRS. This obviously is subject to change, but they're going to actually have a specific code for the tipped occupation that's going to be essentially telling the IRS, the employer is going to be saying, this employee qualifies for this tip deduction, and here's the code that they qualify under. And so I imagine then on personal income tax returns, there's going to be some reporting that is going to be required to indicate what your occupation is. And so that will be important to making sure that you have from your employer on your W-2 at the end of the year, as well as then the other piece of it is that they are going to they've announced with this draft 2026 W-2 form that there are going to be additional codes that indicate what amount of qualified tips were received by an employee, as well as qualified overtime. And there's also, as kind of noted on there, for the Trump accounts that Lisa had spoken about, there's gonna be a code there for the employer contribution piece that was mentioned. That will show up on the W-2 as well. And so obviously if things change, we will be following that very closely. But at least for right now, it looks like the key indication for any employees in 2026 and beyond is going to be these codes on the Form W-2. As I mentioned, the 2025 guidance is for this provision as well is still kind of waiting. We're waiting on the IRS to issue that, and we will of course be communicating that as soon as we know more for 2025 guidance. But to get back to the tips deduction, again, it's very similar to the overtime deduction. The thresholds for being considered a highly compensated employee is the same at $160,000. The phase out for married filing jointly and single or head of household taxpayers is the same. And also similar to the overtime deduction, the married filing separate status also kind of has a penalty to it in relation to whether or not you can take this deduction. A couple of things to note about qualified tips are noted here on this slide as well. I would highlight though that the idea of cash tips, a lot of people have been concerned, again, social media primarily, about whether or not cash tips means actual dollar bills versus other forms of compensation that can occur in terms of tipping. And it does mean kind of, the more broadly general sense of tips, meaning cash tips, meaning that it has to be, either dollar bills, but it could also be credit cards. It could be, kind of those typical payment ways of paying for a service. Those tips can be allowed. It basically just excludes, like, you can't tip somebody with a chicken and have it be a deduction for the tip deduction. But cash and credit card tips are kind of the general sense of what that means. The other aspect to this that is important to realize is that it has to be a voluntary tip. So if you're ever going to, say, a restaurant and they have just kind of the surcharge due to the size of the party that's at the table, those types of charges will not qualify for this tip deduction. And so a good thing is the fact that for other reporting that happens with tips, most employers probably are already tracking the distinction between, say, voluntary tips versus involuntary tips. And so they will just have to hopefully leverage that information to then properly report this on the W-2 under that code 12 TP box code to properly disclose that. A couple other things to be aware of, just related to the qualified business income that Amanda is going to be talking about here shortly. One of the things that changed in relation to the tips here is that there is some interplay between if you're taking a tip from a qualified business, but then also in terms of if it's a qualified business, but it's a SSTB business, then you're going to have to take into account the tips that are being received through that business. And that also includes those business employees, which is again another reason why accountants won't qualify for this deduction, because we're an SSTB type of business. As we go to the next slide, just some other kind of reiterate some of the things already touched on specifically. But the reporting is going to happen on forms. Obviously, we showed the draft that's come out for the 2026 W-2. We're expecting similar drafts to come out for 1099s related to contractors that are receiving a 1099-NEC, or if you're receiving tips through some sort of kind of aggregation payment processor on a Form 1099-K, that will also be something that happens. So I imagine a lot of restaurants, or maybe not like a full service restaurant, but maybe like a food truck or something like that that has credit card processing, you would also receive for your self-employed business, a 1099-K, and the Square or whoever is processing things will have to then report on that, the amount of tips that were received and processed through them. Another aspect is if, of course, unreported tip income, the question is going to be a matter of how that is going to come into play here. And so just a kind of a reminder that if you're receiving tips and they're not being reported to you through your wages, you need to use Form 4137 to report those, and that will be obviously more important, I guess, now, with this ability to then take a tip deduction, ensuring that you have the proper reporting done. The other kind of items that are on here that I would just highlight again is the Social Security number requirement, and just the implications of not having that when you're filing. I would definitely, again, highly recommend kind of those things are paid attention to. That's kind of it for those two provisions. Our next provision to look at is employee retention credits. And this is kind of more of just a FYI about things for this provision. It's a provision that has ended. So if you hear or receive a phone call or some sort of communication from somebody trying to promote, you should apply for this credit still. Really, those are fraudulent claims. They are not allowed to be processed now. They got this bill. The IRS had actually already stopped and announced they were stopping accepting submissions back in January of 2024. And this has made that an official stance within the bill. And so just being aware that there are some significant penalties for fraudulent filings. If there are any issues, if you've filed something and realize that, hey, we need some help addressing this, we can certainly help. There are some provisions out there for essentially kind of saying, hey, somebody, a promoter approached me and I thought it was real, but turns out it's not. I understand that now and I want to, essentially cancel my claim for a refund. There are some provisions for doing that. And we can certainly help you work through that. Also, just the fact that if there were erroneous claims filed or processed, there are some additional penalties that now are in place for claims that are received after July 4th of 2025. And that is all I have for my sections. Now, Amanda, one of our managers here in the tax group, will be happy to talk through some of our business provisions.
Thanks, Will. As Will mentioned, I'm Amanda Kelly, a manager here at Holsinger in the tax department. I'm going to touch base on some business provisions that will affect the broad audience. There may be some industry-specific tax law changes that may affect you. We are not going to touch on those today. The first topic, qualified small business stock. The Act enhanced the gain exclusion on qualified small business stock, expanding the holding period to exclude that gain. A qualified small business stock is domestic C corporation stock that meets some qualifications. You must have 50 million, in assets at the time of the acquisition of the stock, must engage in business activity, meaning it cannot be an investment corporation in nature, and the stock must be acquired directly from the company, not in a secondhand market. The changes here apply with acquisition of stock after July 4th, 2025. The exclusion now permits a 3-year holding period to exclude 50% of the gain. At a 4-year holding period, you may exclude 75% of the gain. And after 5 years, you can exclude 100% of the gain. Previously, the holding period was the 5 years at 100%. So now you have more options here on this holding period. The 1099 thresholds have been increased. So the 1099K reporting requirements are now exceeding both 20,000 in gross payments and 200 transactions, and this change applies retroactively. and Form 1099s threshold increased from 600 to 2,000, which will be adjusted for inflation, and these are payments made after December 31st, 2025. So the next handful of slides I'm going to go through are changes in depreciation. Depreciation leans a lot into tax planning, so the next 3 slides will be beneficial for you to reach out to a wholesaler team member here for some consultation services and tax planning surrounding the deductibility of depreciation. Firstly, bonus depreciation was made permanent. This is good news. So the Act permanently increased and made permanent 100% depreciation on qualified property placed in service after January 19th, 2025. Bonus depreciation applies automatically, so if it is more beneficial for you, you may elect out of bonus depreciation, and that's a good planning opportunity there. You may choose for 2025 only to deduct 40% bonus depreciation. This was because that was the rate, that was the intention for 2025 before the Act made permanent the 100% bonus depreciation. You may elect out of 100% bonus depreciation in its entirety, but you must do so for the same useful life class. So if you wanted to elect out of 3-year property that qualified, you would not be able to take bonus depreciation for any 3-year property. Section 179 depreciation. The Act made permanent the increase of the deductibility up to 2.5 million in business property, which will be adjusted for inflation. So examples of qualified property would be your property and equipment, machinery, and software, things of that nature. There is a phase down of the 179 deduction. So once your qualified purchases reach $4 million, the deductibility under 179 begins to decrease, and at 6 million in purchases, you are not permitted to take the 179 deduction. Again, the 2.5 million is adjusted for inflation, and this effect takes place in tax years beginning after December 31st, 2024. So this will apply for this tax filing period. The Act did introduce a new special depreciation for qualified production property. So the Act permits 100% write-off for qualified production property used in a qualified production activity. So what is this? Qualified production property is non-residential real property that's used in manufacturing, producing, or refining tangible property within the United States. This property does not include property used for a variety of functions. So if you have a warehouse space that also holds your offices for sales or research activity, that property would not qualify as a qualified production property. There are some exceptions also when it comes to this type of property. So the property could not be previously used by the taxpayer. The property could not be previously used by another taxpayer in a qualified production activity. And this property cannot be acquired from a related party. So this new act part of the Act applies to property placed in service after July 4th, 2024, and before January 1st of 2031. The construction was permitted to begin between January 20th, 2025, and the construction must be completed by December 30th, 2029. So one thing to consider here is if the property ceases to qualify as a production property, you do have to recapture the accelerated depreciation. It is subject to a 10-year recapture rule. So that's something to keep in mind if you're not going to hold on to that property for production purposes. Moving on to the next topic is interest expense limitation. Now, this limitation does not apply to small business taxpayers, so that's just something to keep in mind. But there is a 30% limitation on the deductibility of interest expense. And that 30% limitation previously was based on adjusted taxable income. So the Act did modify the definition of what adjusted taxable income means. So now that adjusted taxable income is based on EBITDA, whereas you can now add back depreciation, amortization, and depletion when arriving at that income base for the deductibility of the interest expense. So that's really great news, given all the special depreciations that came into play with the Act. So adding back that large depreciation deduction will allow you to have a larger adjusted taxable income base to calculate the limitation on your interest expense. Also to note, I should mention that the interest expense does not apply to any interest on flooring plans if that's part of your business structure. Research and development expenses. There has been a lot being released on this topic daily. So research and development expenses are now permitted to be deductible, and this change is retroactive to tax years ending after December 31st, 2021. So under previous law, you did have to capitalize those R&D expenses over 5 years for domestic expenses and 15 years for foreign expenses. So the Act now permits these to be deductible retroactively for domestic expenses only. So what does that mean? Small businesses may now retroactively apply this change, and there are some options on what you can do for the tax periods that have already been filed. Small business taxpayers are permitted to amend their tax returns to deduct the research and development expenses that were previously capitalized. The small business taxpayer may also be able to spread out the deductions over the 2025 and 2026 tax year. If you have not filed for 2024, you are permitted to elect to take the research and development expenses in 2024, but by making that election, you are electing to deduct those expenses back to tax years after December 31st, 2021, and that will require you to amend those tax returns. So there's a lot of tax planning here and a lot of consultation needed in regards to how you're going to go ahead and treat your past research and development expenses that were capitalized. So again, encouraging you to reach out to a Holsinger team member to work through your options. Business meal deduction limitations. So the Act now introduced a new limitation on the deductibility of business meals. The Act now is not permitting a deduction for business meals paid by the employer for the convenience of the employer on the employer's premises to their employees. It's a little confusing, so I'll define what that exactly means. So business premises are meals in employer operated cafeterias or other facilities. So if the employer has a cafeteria that the employees can freely gather a meal at, those meals are not deductible for the employer. If the employee pays for the meals, of course, that's a different scenario altogether. But if you have an employer operated cafeteria or other eating facility, those meals will not be deductible. And for the employer convenience, that means that you're providing the meals to benefit you as an employer to ensure that your employee is working during traditional meal periods, in emergency situations, and overtime situations. So those meals are no longer deductible. I'm going to move forward to the chart, which makes it a little bit clearer to go through. So the first two bullet points are discussing the new changes on the 0% deduction for employer-provided meals on a business premise for the convenience of the employer. Those two first bullet points go hand in hand. Business meals with clients or prospects still remain at 50%. So those meals with clients and prospects need to have a business purpose relation. And we always encourage you to notate the who, where, and why of those types of meetings. Meals while traveling for business. So if you're paying for your employee meals while they're traveling, overnight stays for business, etc., those still remain at 50%. And then you have your company-wide parties, picnics, think your Christmas events or holiday events. Those remain 100% deductible. So we do encourage you to keep track of those independently. Maybe think about generating multiple chart of accounts so that you can easily identify, making sure you're gathering that 100% deductibility there, and then not losing out on any deductions that may be buried. We, of course, will review those with you at tax preparation time. The Act also introduced a floor for corporate charitable contributions. So there's now a 1% floor for the deductibility of charitable contributions. So for C corporations, the charitable contributions are only deductible if they exceed 1% of taxable income, and they still remain capped at the 10% limitation. So the contributions disallowed either for either limitation may be carried forward for 5 years. This change will take effect for the current tax filing period, for next year, tax years ending after December 31st, 2025. So for a brief example, if a company has 2 million in assets and a contribution of 15,000, their floor would be set at 20,000. Therefore, they would have no charitable contribution in that given year. That charitable contribution would then be carried forward for 5 years. And once they reach their floor in any given year, they can recoup or take those charitable contributions. Again, they will drop off after a 5-year period. Disguised sales and payments. So the Act now gives the IRS a bit more power in reclassifying potentially abusive transactions between partners and their partnerships, commonly referred to as disguised sales or payments. So what does that mean? A disguised sale is when a partner receives money or property from the partnership that could be, the IRS could look at that as a hidden sale rather than a distribution from the partnership. So if a partner, for example, could potentially contribute some form of property and receive as a capital contribution, and then quickly in turn receive a distribution from that partnership, the IRS could reclassify that as actually a sale to the partnership from that partner, and that therefore that partner would have taxable income on that sale. This change applies to services performed and property transferred after July 4th of 2025. Much like the individual provisions, the IRS is terminating many energy credits and incentives for businesses. So I think the takeaway here is if you're concerned with the environment and you are looking for these credits, make sure you pay attention to the dates on these slides. Very similarly to what Lisa had gone through earlier in the individual slides, there are place and service dates and requirements for when construction needs to begin or assets placed in service, etc. So I would just refer to this slide for future reference. I had it easy. That's all I have on the business side of things. So again, we really would like to encourage you to reach out to your whole senior team member here in order to discuss anything that sounded like may have some potential for you under the One Big Beautiful Bill. We are here for you. We will continue to send out newsletters and updates. So we encourage you to stay in touch with us and read the constant contact emails that come out. Again, there's always guidance coming into play from the IRS. So we will keep you in tune with anything new here.